Hey everybody, Courtney Smith here with our Wall Street winners for March 29th. Let's dive right in. And here's the deep end of the pool that we're going to dive into. Okay, S&P, we had the little dribble, but I told you that that would not last long. We just had to look at the seasonality and some of the other factors to see that this market, it can't be kept down. It's going to sluggishly move higher. We're in a sluggish bull market, not explosive. It's summertime. We're getting into the summer seasonal boring period. And so we're going to continue to move higher because conditions are still bullish, but we're not going to explode to the upside, nor are we going to drive to the bottom. Maybe in the fall we'll see a dip, but let's keep monitoring factors now. Let's stay long and make money on the long side. Of course, if you're a fully paid up member, you know we're making money on the short side with one of our themes. Buying pressure took off a little bit, but selling pressure didn't go down. So this is what I'm saying. This is a recipe for a sluggish bull market, not an explosive bull market. NASDAQ, on the other hand, look at that. I mean, we got a rebound on Thursday and Friday, but it was weak compared to the other two major indices. But look at the purple predictors starting to build up bullishness. And we had broken the new highs on Monday. We failed to on Thursday and Friday, but we got awfully close again. The point is, the purple predictor is getting more bullish, and so we're going to start to see the NASDAQ play catch up with the other two indices. Seasonality remains bullish. Now, let's take a look down at the bottom. The normal seasonal bullishness for utilities is May 1st to October 31st. But seasonality can come in a little early, it can come in a little late. I mean, it's not precisely May 1st. So normally I start looking at the beginning of April. Guess what? We're almost at the beginning of April. So if this bull move that we've had since the beginning of March continues in Utes, we may start buying Utes next week because that'll be a little bit of an early move, but it will have broken above the green line that I put on there, which was January's high. So we might be getting into these Utes here pretty soon. You can see here the two colors we're looking at are the red and the purple. The red is the post-election year after the incumbent party loss, and the purple line is the first year for a Democratic president. Generally speaking, I would say the first year of a Democratic president is probably more accurate. And so we're going into a period here that's, choppy, a little bit bullish. Sounds about right to me. Okay, asset allocation. We're still sucking money out of the bond market. Bonds, what we're seeing is because long-term yields have gone up, then it's still amazing. They're afraid of the bond market. See, when yields go up, the price of bonds goes down. So all bondholders are now losing money on their positions, and they're saying, hey, I'm going to bail out and get me some of those stocks. The stock market Riskicator, though, took a little bit of a dive here. That was very interesting to me. It's only 1 week, so we have to monitor it, but there's a little bit of an early warning sign there that maybe the stock market isn't as strong as it was. Global shares doing okay, but who cares? Yield curve, whoa, still moving higher. We're now up, we got up to 1.7, which is a decent yield curve, particularly since yields are so low. So this is very bullish for the stock market, very bullish for the bond market, for the economy a year from now. Remember, this is a long leading indicator. So look for next year to be a good year for the stock market. Bonds got a rally, but then they started to fade late in the week. Key factors, interesting. The bull market that we've seen in yields and the bear market in bonds, we might have a pause here. Let's start on the upper right-hand corner. You can see the CRB index, which is the chart itself, took a little bit of a dip. Of course, gold's been in a bear market for a couple months, 6 months. And then down at the bottom, the blue line, those are 10-year yields in Germany. They're going down. So all three of our indicators are actually going down right now. So look for a pause in the climb in our in the 10-year yields. In other words, 10-year yields might come down a little bit and flatten the yield curve a little teeny bit. Dollar stronger, as we said. I remain bullish on the dollar, although there are some shaky things about it. The current account balance, for example, is very poor and getting poorer. But nonetheless, we have a bull market in the dollar. And if we have a bull market in the dollar, that means, you got it, gold is under pressure. I think gold's just going to continue to go under pressure because real interest rates are moving very high, particularly on the long end of the yield curve. And real interest rates are one of the key factors that affects the price of gold. Our gold key indicators, bearish. Even the one that's neutral is drifting lower. So it's not exact. I mean, you might even say there's 3 bearish, but let's call it 2 bearish, 1 neutral. Crude oil under pressure. I think it just got too high. Of course, I said that $10 ago, but better late than never. I think it just got too high. And we had simply because it started to choke off the demand. The world economy is not doing that great. You know, every place is doing a little bit better, but everybody knows that, so it's already factored into the price of oil. Bitcoin, same thing, just not that excited. Obviously have to remain bullish, but let me just show you something that disturbs me. Go back 2 weeks ago. Bitcoin breaks to a new high, but the purple predictor doesn't. That means we have a momentum divergence here. And now, of course, we've been under pressure since that divergence occurred. So we're resolving the divergence now, but it's going to take quite a few weeks before we can go make a new high again. So look for Bitcoin to basically stabilize around these levels, be up a little, down a little, no big deal either way. All right, freebies, thanks. Love having you here. Of course, you should be a fully paid up member because that's what all the cool kids do. All right, fully paid up members, hang on in just a second. Hey, freebies for Wall Street winners. Really appreciate having you here and love to have you participate in the Wall Street winners every week. But I also wanted to show you where I get a lot of my information and where I monitor my information, and it's from the Stock Butler, stockbutler.com. And what it is that it takes the system that I teach in my Stock Financial Freedom System course, my live 2-day seminar, and it codifies and systematizes and makes it super easy to use. Let me just show you some of the things. I would go there, read their literature, that's really great. But let me show you a couple of things that I use. So I always talk about in Wall Street Winners our best of the best stocks. Now, when you're a fully paid up member, you see my best of the best stocks. But for example, I can come up here and I hit rate and I go to best of the best and I click on it. Now I've already signed in. There it is. There's my best of the best stock. These are the best of the best stocks that you should be looking at buying. In this particular case, you can see the green one is a new one this week. So guess what? In the fully paid up section, this is a new recommendation. We also, Stock Butler also rates the stocks, A, B, C. Here is a change. This one was changed in its rating. So it does some amazing things. It makes it super easy for you to trade, to monitor. It also has other techniques up here. Our hot hands, our pit bulls, seasonality, advanced stock list, many different ways in order to find great stocks and then to monitor them. So when you click on one of these stocks, it comes back and it tells you how the rating occurred. Here's the actual analysis that went in to rating this stock a B. Incredible. And the cost is nominal. I highly recommend it. Go there to stockbutler.com and check it out. I think you're going to love it. Talk to you later.